And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, this is a holiday shortened week. Thanksgiving just around the corner. I was just talking to Brent here before the show. Spent the weekend getting the house ready. We've got like 30 people coming over for Thanksgiving. So I am broke now after going shopping for groceries. So if my kids are listening, don't call me for money. I don't have any. So anyway, but no, it's Thanksgiving week, of course. So market this week is open today, tomorrow, Wednesday. Markets are closed on Thursday, open half a day on Friday. So they close at 1 o'clock New York time, 12 o'clock noon Central Standard Time on Friday. So very light trading week this week. Most traders are already gone. Look, if it wasn't for you guys, I wouldn't be here either. So just know I'm here for you for 2 days. I'm off on Wednesday, Thursday, Friday. We'll be back the following Monday. But having said that, markets are going to open up very nicely this morning. 30 points higher on the NASDAQ, 30 points higher on the S&P this morning, 300 points higher on the Dow Jones this morning. Again, as we talked about last week, that we'd gone through some kind of traditional sloppiness that we typically see about mid-November. And then you typically get a rally going into Thanksgiving because there's nobody around. It's inmates running the asylum right now and everybody's very bullish. So again, a bit of a rally this week won't be surprising. And then a rally into the end of the month following basically Black Friday. We're going to get a rally into the end of the month and the first 5 days of December typically. So that'll be kind of excitement over the Black Friday shopping, all that's going on this week. Expectations are that consumer spending is going to hold up well. Retail sales will be doing fine, so we should get some good reports that'll help kind of lift the markets into the first 5 days of December. Now, after that, as we've talked about previously, we're going to have a little bit of volatility as mutual funds make their distributions. But that's just here over the next week or so. The setup for the end of this week still remains bullish. So again, potential market push to the upside. We'll talk a little bit more about that in a moment because there was some news over the weekend that's got the markets a little bit excited today. One of the markets are up. We'll talk about that in more detail in the show this morning. But outside of that, economic data is going to be very light this week. Of course, once we come back on next Monday, we'll start getting into CPI, PPI. We've got the Fed meeting on December the 18th, employment report. So a lot of data will be coming at us starting next week and as we get into the second, third week of December. Before Christmas, we're going to have a lot of work. But again, that's the other side of this coin is that if you haven't started your holiday shopping yet, you need to get started now. I thought I had time. I ordered my wife's birthday present. I can tell you what it is because she told me what she wanted and she already knows what she wants. So it's a wet dry vac. But I ordered it today, this morning, like 4 a.m. I ordered it on Amazon because her birthday is Sunday. But Amazon won't deliver it till Monday of next week. So it's now, normally you order stuff from Amazon, you get it the next day or two, right? So it's because of the rush for the holiday season, delivery times are starting to get pushed out already. So point is, if you haven't started your Christmas shopping, you better get on it. So it's right around the corner. It'll be here before you know it. It's like 4 weeks away. It's Christmas. So that's coming up quick. So get your shopping done. Okay, let's talk a little bit about the markets, what you need to know before the bell this morning. So the S&P is doing fine. We keep talking about this kind of ad nauseum. There's nothing to worry about. Lots of negative headlines, though, keep coming out saying, market's going to crash, this, that, and the other thing. Really no sign of that just yet. We had this bit of weakness that we saw post the Trump election. Everybody got very excited with the election, had a little bit of a pullback, not surprising. Held support at the 20-day moving average, had rallied off that last week, and again, that's going to continue today. Goal today, really, for the market is to try to generate about 50 points to the upside, retest the 6,000 level on the market. That will probably try either today or tomorrow to do that. I wouldn't be surprised. Breaking out to all-time highs this week would not be a surprise at all either at this juncture. But again, the markets are doing just fine. We're about to flip that short-term sell signal back into a buy. So again, that'll help give the markets a little bit of lift. Now, just understand this is still at a very high level. So upside is going to be somewhat capped here. I wouldn't expect this market to run off to 6,200 anytime soon, but certainly could. But with signals kind of fairly elevated right now, it's going to be a little bit more of a challenge to generate higher prices here in the near term. Markets are not yet completely overbought yet, but they're going to be overbought today or tomorrow, depending on this rally. So again, there'll be some limited upside here. Certainly want to participate with it. But I think 6,000, that nice kind of, the market wants to get to 6,000. They want to break through that. That's just kind of that big round psychological number that sits out there. Markets kind of get gravitated to it. So again, this test of 6,000 today, tomorrow, Wednesday will not be surprising at all, just because again, it's sitting there. The markets know it's there, and they're going to try to get to it. Outside of that, this morning, we're going to see 10-year Treasury yields perform a little bit better as well. Over the weekend, there was a nomination for Treasury Secretary. We're going to talk a little bit more about that this morning, because the markets may have this one wrong. We'll see. But very excited about Scott Bessent, who is basically a fiscal hawk, getting nominated for Secretary of the Treasury. So bond yields are going to be dropping pretty sharply this morning, as expectations are that he'll start kind of reducing the debt and the deficit. Again, this is one of those kind of platforms of the Trump administration, which is to reduce the deficit either through the Department of Government Efficiency, his Treasury pick, and a variety of others. There's this focus on trying to reduce spending and the deficit. We'll see how that goes. Market volatility remains exceptionally low here, and again, not surprising. We're back down to 15 on volatility. So again, since the election, a lot of that pre-election risk, concern about the market continues to keep volatility extremely suppressed. It's very hard to kind of expect volatility to drop much further from here. It certainly can. We've been down to 12 before on the volatility index, but again, it's just we have very, very low volatility in the market, and we just kind of continue to grind higher, here in the short term. Outside of that, the dollar has been exceptionally strong, had a little bit of a pullback going on this morning, but again, not surprising. We've had a huge rally in the dollar. It's very overbought here. We do need a bit of a correction in the dollar here before it can make any kind of moves higher. But again, just this huge rally in the dollar. Again, a lot of this is now really kind of driven on this idea that policy and regulation under the new administration is going to lead to stronger economic growth. One of the the draws of that is stronger economic growth pulls in more money in foreign reserves into the U.S., and that of course winds up either in bonds or in the stock market. And so again, we kind of continue to see foreign inflows into the U.S. very, very strong, continues to support the market on that front. Obviously, we can't not talk about Bitcoin this morning because, again, it's interesting is that, there for a long time, Bitcoin was not doing a whole lot. In fact, over about a 2-year period, we'd gotten very overbought on a MACD basis back in early 2024 and pretty much just didn't do anything here for a while, and all the laser eyes went away on the internet. Well, now they're all back. So, in fact, this morning I posted out a tweet that said, markets are exceptionally overbought here and investors are chasing leveraged ETFs. This won't end well. And I got responses back saying, yeah, it won't end well for those guys, but if you're in Bitcoin and MicroStrategy, you'll be just fine. So, no, Bitcoin is exceptionally overbought here. You're going to have a correction in Bitcoin at some point. You've got a very, very elevated MACD that's about to trigger a sell signal. So again, when you get that sell signal, you're likely going to go through at least a consolidation process, if not a pullback. So just be aware of that. That's just part of trading, and that's kind of what happens to markets over time. That's what you need to know before the bell this morning. We'll come back. We'll talk about the new Secretary of the Treasury pick, what that might mean for the debts and the deficits, and more importantly, what it means for the markets. We'll talk about that this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So over the weekend, President-elect Donald Trump nominated Scott Bessent as Treasury Secretary. Scott is a manager of a hedge fund, longtime investor, very well respected, has a lot of background in economics and kind of geopolitics. So again, it's an interesting pick because, this is a guy who, by his nature, is more of a fiscal hawk than he is a dove. And this is going to be interesting how this kind of works out because over the last 115 days, the U.S. national debt increased by $1 trillion. We're now at $36 trillion. And again, not lots of concern. People are like, oh my gosh, $36 trillion. Yes, it sounds like a lot of money. It's 120% of debt to GDP. And it is a lot of money, right? It is a lot of debt, but it's not the end of times, and the U.S. government is not about to go broke. But what that does mean is that all that money that's getting spent has been winding up in the U.S. economy and the U.S. stock market. It's been driving corporate profits, and I told you I've got an article coming out on the Kaliki profit equation, which explains why corporate profits remain at all-time highs. And that's what's been driving the stock market. So one of the interesting byproducts of Scott is that if he is a fiscal hawk and focuses more on, debt and deficit reductions, a couple of things are going to happen. First of all, as the government starts to reduce their overall deficit, right, which is kind of the goal, either through the Department of Government Efficiency, as I said just a moment ago, or whether it's through the Treasury, if you start to work to reduce the government debt and the deficit, that is a subtraction from corporate profitability. That's going to weigh on the stock market. If you start cutting government spending, government employment, etc., that's going to lead you to a recession. Because government spending and government employment has been making up a big chunk of our employment over the last several years. Government spending has been supporting a lot of the economy through, the Inflation Reduction Act, all this other stuff that we've been doing. That's been flowing into the U.S. economy, creating jobs, etc. but that's what it is. So if you start to reverse that, that's going to have an impact on markets and corporate profitability, earnings, etc. And that's going to lead to more volatility in stock prices. So there's a give and a take to this. And it's important that you understand the dynamics of this. And again, I have no idea how this will actually turn out because, again, it depends on how they approach these things. If the deficit reduction is a very slow, gradual process, then okay, you might be able to navigate that, maintain, slightly reduced levels of corporate profitability, maybe avoid a recession. But if you become very aggressive about it and we start eliminating entire, swaths of the government and on a very rapid order, kind of as what is thought to be the case, that, Elon Musk and Vivek Ramaswamy will come in and just kind of pull a Twitter and just lay off 50% of the government employment right up front. Now, that would be devastating to the economy. You can't do that. But again, would it be good long term? Sure. And as we talked about before, pain isn't a bad thing, right? The financial crisis was a great opportunity for us to clean up a lot of things in our debts and our deficits and government structures, the banking system. You should have allowed the banks to go bankrupt. Goldman Sachs would be out of business. JP Morgan would be out of business. Bank of America and Wells Fargo would definitely be out of business. But those failures would have been absorbed by small and regional banks around the country. They would have grown bigger. And yes, it had been very painful for a couple of years, but we would have a much more diversified banking system across the country. We wouldn't have a banking system that's dominated by 6 banks. So there's give and takes to all these things, but you don't really get out of these things without some pain along the way. And I'm not saying there's going to be massive pain. I'm not trying to tell you there's going to be a 50% correction. I'm not saying that, but I'm just saying is how you approach this transformation of government is going to be very, very important because there are potential risks to that of a recession, economic pain, et cetera, that will translate into the economy. Now, let's just assume that while corporate CEOs are, kind of sighing a huge sign of relief over Scott Bessent to lead the Treasury, they're hoping that he's going to be a very, kind of reliable and steady choice, right? Janet Yellen was pretty much just whatever Biden wanted to do, she was all behind it, right? Scott's not that way. He's going to push back against the administration on things that he doesn't think are good for the Treasury. So he'll probably work very well with Jerome Powell, who's kind of cut from the same cloth, more or less. But you should also expect that if things start to work, and we begin to reduce the deficit and the economy starts to slow down, the Federal Reserve is going to step in along with Scott. Jerome Powell is going to say, hey, here's what we're going to do. We're going to restart QE. We're going to cut interest rates more aggressively to offset this reduction in deficit spending, which is now weighing on the overall economy. So again, nothing's going to work in isolation, and that's going to be the clear point about this. And the one thing that people often forget is that the Federal Reserve is still a huge player in this game. And ultimately, if push comes to shove and things begin to slow down too quickly or financial stress shows up in the market. In fact, I've got an article coming out tomorrow talking about credit risk, credit spreads in particular. And there is no perceived risk to the markets right now. Credit spreads are exceptionally low. There's no financial stress to the banks right now, even with higher interest rates. But if the Treasury does, let's say Scott comes in and does something very drastic, and he says, okay, we're not going to issue any short-term paper. We're going to only issue long-term debt at 4.5%. Wouldn't make any sense, but let's just say he does that. That's probably going to have a big hiccup to the market. The Fed's going to step in and say, okay, there's going to be too much debt issued on the long end for banks, for the primary dealers to absorb. That would cause congestion in the markets if that would occur. This might won't occur, but just I'm using it as a kind of an extreme example. And the Fed would step in and say, okay, we'll relieve that congestion. We'll start buying the debt. You sell it to the banks. We'll guarantee the banks that we'll take it off their books within 2 weeks. So again, for every give and take, for every action, there is a reaction, and the Fed still has a huge lever in this game. So, if we begin to see any type of financial stress, if we start to see credit spreads start to rise, if we begin to see collateral at banks become, under pressure, et cetera, the Fed will step in. And again, since Scott and Jerome Powell both kind of come from the same cloth, they will work very well together on this. So, again, and that's one reason why bond markets are rallying this morning. Another reason stock markets are rallying this morning is looking down that line. So this is actually kind of all good news. Of course, it'll depend on whether or not he can get, passed by Senate and Congress, and we'll see. But appointments are going to be the next kind of big challenge for Trump. All right. But having said that, that's kind of just the outlook right now. So that was kind of the big news over the weekend. It's kind of moving the markets this morning. And one thing we'll talk about when we come back from the break here in a minute is talk about market forecast for 2025. They're very, very optimistic. And this was kind of the subject of the newsletter this weekend. So if you haven't been by the website, make sure you go by the website. If you haven't checked out the new website, you should. But under the resources tab, go to the newsletter. And this weekend's newsletter kind of covers this outlook for market forecast for 2025 because they're very optimistic. Everybody's optimistic about 2025, and they should be, right? You've had two years back to back of 24% gains for the markets. Pretty incredible. It's only happened like 4 times in history, and typically the next year tends to be positive about half as much. The average return after 20% return years is about 12% on average. So again, you should expect a little bit less return next year, but again, overall tends to be more positive than not because basically the bulls have momentum. There's a lot of momentum in the market, lots of excitement, new administration, this kind of deregulation, America First policy. That's very beneficial for markets. They like that. So again, there's a lot of optimism going into 2025. One of the risks here that we need to keep a watch on is on the CIti Surprise Index. This is an index that you can look up on the internet. It's called the CIti Surprise Index. And basically it just measures economic surprises. In other words, when the data comes in better than expected, then it causes the index to go up. And lately, we've had a very long spat of economic surprises. And again, this is the economy's doing better than what expectations were. The problem going into next year is that now economists are exceedingly optimistic about the data for next year, expecting huge jumps in consumer spending next year. That sets up for disappointment. That's going to be one of the risks for next year, is a little bit of disappointment. We'll talk about that when we come back from the break. Don't go away. More of the Real Investment Show coming right up.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, our IA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with our IA advisors' online resources and one-on-one partner to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My son, Thomas, who really good-looking kid. And so he's starting a business for Thanksgiving to provide Thanksgiving packages.
The Real Investment Show podcast.
For $75, he'll show up at Thanksgiving, with a girl and, tell a cute story of how they met. They'll stay through dinner and then, give the parents a hug on the way out.
Same show, your schedule.
Quite a business idea. I wonder if there's a package in there where he wears the matching ugly Christmas sweater.
At realinvestmentadvice.com.
No,
to the
that's
family, too.
that's the Christmas package.
That's the Christmas deal.
Coming up.
Okay,
so
got it.
yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I love all you young whippersnappers in our chat channel. There's PD was in here criticizing me for not going to Lowe's to pick up my wife's birthday present. Let me explain to you something about when you're my age and have been married 900 years. Brent will confirm this. We don't wait in line for crap. Have you ever wondered why old people go eat at like 5 o'clock at night? That's, by the way, that's my wife and I. We go to dinner. It's 5:30. We go to dinner. You know why? We don't wait in line. Ever. We just go eat, we do our thing, we go home, chill out, right? Old people, we don't wait in line for things. We don't put up with nonsense. We don't care about your feelings. You get over that. And when you've been married 900 years, if a present is a day late, nobody cares. You just tell your wife, say, babe, I ordered this for you. Here's a picture. It'll be here tomorrow. Thrilled. We're way past the jewelry stage. Okay. I still buy her jewelry, but she doesn't mind waiting a day, especially when I saved her money. So there you go. Anyway, and she gets what she wants. And look, that's the other thing. When you're to the point in your relationship that your wife is excited about a dry vac, a day doesn't matter. Young people. Go wait in line. No. Anyway.
What's the quote from It's a Wonderful Life? Youth is wasted on the young.
Exactly. All right. Let's talk a little bit about market analysts. Markets are very optimistic about the future. and they are particularly optimistic about 2025. Bring this chart up for me, Brent. This is a estimate from Morgan Stanley. Their base case is 6,500 for next year, and their bullish case is 7,400 for next year. That is a pretty strong rise in the markets next year. Now, the importance about this is that this is from Michael Wilson, who is a longtime bear. He has been bearish on the markets for the last 3 years. Crash is going to come. Markets are going to crash. Markets are going to be lower. His, kind of his bear case is still around 4,500, but that's where it's been for like ever now. He's finally flipped bullish. And this is literally the last bear standing. He's finally gone bullish. And so that's just this market, right? This market has just gotten everybody to the point that next year expectations, I'm going to pull this chart down, Brent. Next year is going to, expectations are very high going into next year. And a lot of this is being driven by what is termed animal spirits. And animal spirits are basically psychology. Everybody's psychologically, I'll spit that out, very optimistic for next year. Now with the Trump election, America First, economic policies, deregulation, all this, everybody's very excited about next year. But the problem with that is that we typically kind of get ahead of ourselves in a lot of cases. And, valuations right now on both the trailing and a forward basis are very high. And again, as we've talked about before, when valuations are elevated, that's more of a function of short-term psychology. People are just willing to pay more for stocks today because they expect earnings to catch up with the price they're paying today. But, that's the game, right? You continue to overpay for valuations until someday the earnings don't catch up, right? But right now it's all working just fine, but we have very, very elevated valuations on both a forward and trailing basis. And that is, potentially a setup for disappointment. Not always the case. But analyst estimates for earnings next year remain extremely elevated. I mean, it's just kind of literally off the chart type elevated because historically earnings run peak to peak about 6%. So, when you're looking at earnings over the long term and you kind of look at, from one peak to the next, that grows about 6%. That's about the rate of growth, economically going back 124 years. Right now we're expecting a growth rate more than that. And we've been expecting growth to occur with an exceptional rate of growth over the economy for quite some time now. And again, that's just difficult to maintain because earnings are a function ultimately of economic growth. So if anything that happens under the Trump administration, again, going back to cutting the debt, cutting the deficit, if that slows the rate of economic activity, earnings growth is going to slow. And that's going to weigh on stock prices and some of the optimism. One of the big concerns, if you're just thinking about this, is equity risk premium. We talk about premiums a lot, and particularly in the high yield bond market. Right now, if you're buying junk bonds, you're not getting compensated for the risk you're taking. And what's a junk bond? It's called high yield in your portfolio. So if you look in your portfolio and you've got a fund called the high yield fund, right? You own junk bonds or junk credit of some sort. And those are companies on the verge of going bankrupt. And that's why you're getting this exceptional rate of return. But the exceptional rate of return is not that great. You're not being compensated for the risk that you're taking. I do a lot of private credit personally, and I get paid a very high rate of return on very strong collateral positions because there's a risk that they're not going to be able to pay me back. And if they don't, I take their property. I don't want their property. I just want to pay me back. But I get compensated for that risk. And as long as you understand that game and understand how to protect yourself, you're fine. But in just the investing market, you don't get compensated that way. So you're taking on a lot of risks not to get paid for it. Well, the same thing in the stock market right now. Equity risk premium, the premium you're getting on equities for the risk you're taking is at the lowest level since the dot-com crash. So again, it's not saying the market's going to crash, but you're just not getting compensated for the risk you're taking on a lot of fronts. And again, this is just a function of excess optimism. Again, it's animal spirits that's kind of driving the market. So, this is the thing that we kind of continue to focus on going into next year. There is a lot of bullish momentum, a lot of bullish psychology that's going to continue to push markets here near term. But again, I think once we start getting into next year, we're going to run into some bumps along the way. And I think we could see a little bit more of a pickup in volatility next year, see some disappointments in earnings expectations, earnings growth, et cetera. And rates of return in the market will probably be somewhere in the 7 to 10% range, not 24%, right? So you've had 2 years of 24% in a row. A much lower rate of return year next year would not be surprising at all and would actually be kind of normal. But it's going to be disappointing after you've been cranking out 20% a year for 2 years. This has been great, right? But next year is going to be I think it'll be, again, I don't know. This is the problem with predictions. Predictions are only good for about a month at the most. Trying to predict something for the entirety of next year is really a fool's game, but just history, what history and technicals tell us is that we're going to have probably, statistics and probabilities probably have a lower rate of return next year as the market is really far ahead of underlying fundamentals. But again, there's no guarantee of that, and there's no way to know. And this is the problem with predictions. If you're banking your portfolio right now, it's like, oh, well, Morgan Stanley says we're going to get to 7,400 next year. I'm going to go take double long leverage in an S&P fund. That's a huge risk. As we talked about before, predictions are wrong all the time. And even analyst predictions are always wrong. Ed Yardeni puts out a chart of earnings estimates. And he just kind of tracks it from the beginning to where it does. And we kind of do the same thing, but he has a good history of this going back to 1994. And what you'll notice is that analysts are always overly optimistic. McKinsey did a research study on analyst estimates and found out they're wrong 100% of the time, by about 100% too much. So, it's just, but again, we start getting very excited about these analyst estimates coming out. Right now, they're very optimistic for next year. Oh, we're going to have $254 in earnings per share on the S&P next year. That's probably going to turn out to be in the 230s, 240s, right? But we're not going to care about that when we get there because, we'll have something else to focus on. But if you're buying stocks today based on that expectation for earnings to catch up, you're overpaying because the earnings aren't going to get there. And they never do. There's not been a year where you start out and you say, well, earnings are going to be $100 a share and then they're going to be $110 by the end of the year. That's never happened, right? It's always the other way around. So if you're buying stuff right now based on estimates for next year, you're overpaying for it. And we'll see those estimates come down. So just it's important to keep in mind that over time, optimism tends to be wrong more often than not. Now, importantly, this doesn't mean that the markets are going to crash, right? That's not what that means at all. It just means that there is a very high correlation between economic growth and profitability in the markets. And if you take a look at the correlation between profits to GDP, right now, profits to GDP is at the highest level on record. The only other time it was this high was at the peak of the market in 2022. But we've seen previous periods where profits to GDP were extremely elevated relative to the price of the market. That was the dot-com crash. That was the financial crisis. The point is there's a very high correlation between market returns and profits as a percent of GDP. If profits as a percent of GDP decline next year, markets are going to struggle. And there's a lot of reasons to suggest that with record high levels of profits to GDP right now, that a decline next year would be unsurprising. But we'll see, right? We have to navigate this. We don't know. Predicting anything 12 months out is fool's errand. But we'll keep watching this for you and let you know. All right, quick break. We'll be back. Get ready to wrap up the show.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Lots of comments in our chat this morning about marriage and divorce. And Brent, you've never been divorced, right?
No, I'm still with my first wife.
Good for you.
Yeah.
That's how long?
45 years next month.
Congratulations.
Thank you.
That's awesome. That doesn't happen much anymore.
No, it does not.
Yep. So I've been divorced, and my first marriage was a complete disaster. Married the wrong person. And after I got divorced, you know, the only two things that came out of that divorce of any quality were my kids. Everything else was terrible, right? I mean, wrecked me mentally, wrecked me physically, wrecked me, you know, financially. And I swore then, I said I would never get married again. And I was devout to that, right? I was absolutely convinced that marriage was a scam and a sham and you should never be married again. And then I met this person. I met my person. And I think that's the difference, which, you know, we all make bad choices in life and we all make bad decisions and we have to recover from those when we do that. But when you meet the right person, when you meet your person that is your partner, and I think this is, and Brent will tell you this for sure. And I have a very dear friend of mine, Ed Hindy, who used to be on the radio station, and he was always kind of my mentor. And he had a very long marriage to his wife, very close relationship. And I never really understood that, right? Until I met my now wife 15 years ago. Actually, 17 years ago, met her. And we dated for a couple of years, and we moved very slowly because she had 2 kids and I had 2 kids, and we wanted to make sure that they were a family. And our children were very young. My daughter was 1. So we worked for a very long time to build a family relationship. And today, you know, it's always interesting. People ask, well, how do your kids get along? It's like they get along like brothers and sisters. They love each other. They talk to each other every day. They are constantly there for each other, and they call each other brothers and sisters. And that's the way we raise them. But my wife has been a terrific partner. She's a fantastic wife. She works all day. She has a career. She's very motivated. But her true love is coming home to take care of the house. And she cooks, she cleans, she takes care of the kids. That's her passion. And heaven forbid you try to take away her passion. In fact, this whole weekend, all she was doing was baking for Thanksgiving. And I kept interrupting. I'd say, honey, we can go buy that and just, take care of that. She's like, stop taking away what I want to do. And I'm like, okay, fine, you're good. I'm just offering to help if you need it. So, but this is the point. When you find the right person, they're a partner. They're not just a wife or a spouse or a husband or whatever it is. They become a partner in life. And, this is why things work well in some marriages and some marriages don't. And I've learned it the hard way, right? I've learned, and what I learned from my first marriage, when I came out of it saying, I'll never get married again, to I understand what I now don't want in a new relationship. And so when I met my wife, she had come out of her ex-husband was very similar to my ex-wife. Very similar mental behaviors, very similar financial behaviors. And she was looking for somebody that was not her ex. And I was looking for somebody not my ex, right? And we both knew what we didn't want in a new relationship. And we really focus, even to today, we still focus on doing the things that we encourage from each other. So, I want her to be a certain way because that fits me. She wants me to be a certain way because that fits her. And we both work on that on a consistent basis. We spend time, together. We spend, we go out, we still go out on dates. We still do the things to keep our relationship functional, and keep working with each other, caring for each other, working for each other. And so, yeah, we get in fights about stuff. Generally, it's stupid stuff. Generally, we fight about the most ironic thing, or actually it's not ironic, moronic things, because we're stressed over work, right? I have a bad day at work, stressful day. She has a bad day at work, stressful day. She comes home, she picks a fight on something's completely moronic. And basically, I just walk away and say, hey, you know what? I'll be back in 15 minutes and we'll talk about it. And I come back 15 minutes. She's calmed down. Everything's fine. But that's every relationship. You're not going to get away from that. Doesn't mean the relationship's broken. Doesn't mean it sucks. But again, it's a constant bit of work that you have to do all the time. Anyway, don't want to get off on that. But I just see a lot of comments in here about how marriage sucks and never get married. And, being married is one of the best things that's ever happened to me when I married the right person. It builds family. It builds that value of what we do in society. And when everybody's always kind of looking for the meaning of life. And I don't know what the meaning of life is. I just know that my family is very important to me. My kids are important to me. My wife is very important to me. And I really don't care about much else. I don't have a lot of friends. My family is where I spend my time. And that fulfills me. And that's the thing that we all have to try to find, is what fulfills us as individuals. And, that's for you personally. But I do think marrying the right person brings a lot of value. And when you meet somebody like Brent, who's been married to the same person for 45 years, you kind of start to understand that a little bit. And Ed Hindy was the same way. He's been married forever, right? And still loves his wife every day, calls her princess. That's the type of person and relationship you're looking for. Anyway, all right. So that's also what I try to tell my kids too. When they bring home their boyfriends and girlfriends, I'm like, nope, get rid of that person. They're not good for you. And they listen. More often than not, they'll break up because they look at the relationship their mom and their dad has, and that's the relationship they want. And so when I tell them, like, this person is not good for you, they say, okay, I get it. And they move on. So, all right. Yes, Pete, I cannot wait for grandkids. Not too soon. I'm not ready for them yet because my kids are still in college. But yes, my wife and I talk about that quite often. We're very excited for grandkids coming down the road.
That's the greatest club on earth.
Yes. We are, and I am not being called Grandpa. My name will be Motu.
Motu?
Motu.
What does that mean?
Master of the universe.
Okay.
Yes.
I got it.
Because that's what my kids refer to me as.
Yes.
So.
That works.
So my wife is still struggling with her. She will not be called Grandma. It'll either be Tia, Mia, or Mimi, I think. One of the three.
We're going to get some Motu merch?
Yeah, exactly.
Yeah?
Correct. We will. So, but yes, looking very, very much forward to grandkids. My wife and I are already planning how to torture our kids by, taking their kids on trips and not taking them, right? Those type of things. So we've got this all worked out. We're going to buy all those toys that make the most racket possible and send those home.
Spoil them, sugar them up, and send them home.
Exactly. Can't wait. All right. So just going to kind of wrap up the show. I killed most of that segment. I apologize. Dow's up 318 points right now. So again, futures are pointing very nicely higher this morning. One of the things that, I want to talk about, just, kind of finishing up that last conversation, is that, we were talking about how analyst revisions are always negative. And if you take a look at EPS, earnings per share, that annual profit or that annual EPS for 2025 is back to where it was in January of this year. So already, even though we're at 274 on expectation for earnings, that's already dropped dramatically just since August. And this is why I was talking about earlier, is that one of the risks for next year is going to be a disappointment in earnings growth because the economy slows down. And particularly, again, going back to this whole conversation we had at the beginning, talking about Scott Bessent and Jerome Powell, if the government is actually going to start reducing the deficit, which will be fine, right? I mean, I think everybody's on board with reducing the deficit. But, if we can cut the deficit by a couple of trillion, which would bring us almost to a balanced budget, long-term economically, that would be fantastic. But you have to understand that a lot of the economic growth we've had over the last 40 years has come from deficit spending. So again, as I said before, that reduction in the deficit is going to slow economic growth. There's really no way around that. But we've got to be willing to go through that for the long term, that short-term pain for the long-term gain, right? So I think the risk of a recession over the next couple of years is probably higher than a lot of people are expecting. Right now, there is no expectation of a recession by anybody in the financial markets, analyst-wise or economist-wise. Nobody expects a recession because I don't think they're looking at the impact of a big deficit reduction. Either they don't believe one will happen, which is entirely possible. If we go back and look at Trump's first term, we certainly didn't decrease the deficit. We increased the debt by $9 trillion. So if we do that again, you're not going to have a recession. But I do think that if they are serious about reducing the debt and the deficit, which seems to be the general case, you are going to get a recession. The Fed's going to step in, start cutting rates. The Fed's going to step in, start doing QE, and we'll see what happens. But that playbook has not changed. And that's the one thing to remember. So we'll talk about this as we go. All right, that wraps up the show for the day. Appreciate you. It's going to be kind of an interesting week. We'll be back here tomorrow. We'll be gone Wednesday, Thursday, Friday, but we will have pre-recorded shows for you on all of our podcast channels. So Apple iTunes, Spotify, SoundCloud. If you go to our website, you can get links to all of those at our website. But yeah, you'll be able to listen to pre-recorded shows on your phone, right? Through your favorite podcast app. And we'll be back with live video right here in the studio on Monday. So again, see you tomorrow, and then we'll wish you happy Thanksgiving tomorrow. So be back then. Have a great day.